Quick question. What if I told you that 77% of all enterprise networking traffic in the world runs through one company's equipment? Not a startup, not a cloud-native darling. A 42-year-old company out of San Jose that most people still think of as a router maker.
And that company just booked $2.1 billion in AI infrastructure orders in a single quarter. The network, it turns out, is the bottleneck in the AI build-out, and Cisco is the one building the pipes.
That's the story today. Cisco Systems, ticker CSCO, from dot-com darling to mature tech stalwart to maybe the next AI infrastructure play hiding in plain sight. This is Charged Alpha, episode 81. Let's get into it. Cisco was founded in 1984 by Len Bosak and Sandy Lerner, a married couple working at Stanford. They literally invented the multi-protocol router that allowed different computer networks to talk to each other. It sounds basic now, but that was the invention that made the modern internet possible.
Today, Cisco operates across three core segments: networking hardware and software, which includes campus switches, routers, and data center gear; cybersecurity solutions like firewalls and advanced threat protection; and collaboration and observability tools, that's WebEx and their monitoring platforms. The networking segment is still the backbone, but the AI infrastructure pivot is where the growth narrative lives.
The numbers on scale are impressive. Nearly 96,000 employees, $319 billion market cap, $59 billion in trailing revenue, and 77% share of the enterprise networking market. Nobody else is even in the same zip code.
What makes Cisco relevant right now is the convergence of two massive trends. First, enterprise AI is moving from pilot programs to full production deployments, and every one of those deployments needs networking infrastructure. Cisco booked $2.1 billion in AI orders last quarter and expects $3 billion in AI revenue for the full year. Second, there's a massive campus networking refresh cycle underway as billions of dollars in installed switches reach end of life. That's steady, recurring, high-margin business layered on top of the AI growth story.
The competitive moat here is deep. 77% market share creates incredible switching costs. Companies don't rip out their entire network on a whim. $7.5 billion in annual R&D keeps the innovation pipeline full, and the new Silicon One G300 chip is purpose-built for AI cluster networking, which gives them a hardware edge in the highest growth segment. Chuck Robbins has been CEO for 11 years now, took over in July 2015 from the legendary John Chambers. He actually joined Cisco back in '97 as an account manager and spent 18 years working his way up through field operations.
His background is in mathematics, BA from UNC Chapel Hill, and he started his career in application development at a bank before moving into tech. What's notable about Robbins is that Chambers handpicked him, and the board elected him unanimously. He successfully navigated Cisco through the cloud transition and initiated the software-first strategy pivot. He also chairs the Business Roundtable, which gives you a sense of his standing in the corporate world. The AI infrastructure positioning is really his signature bet, and so far, the results are backing him up. Let's look at the financials. Cisco is trading at $80.25, with a market cap of $319 billion. The trailing PE is 28.4, which is elevated by historical standards for this name. But the forward PE is much more reasonable at 17.1, which tells you the market expects significant earnings growth ahead.
That's a big gap between trailing and forward. What's driving it?
AI revenue ramping plus operating leverage. Revenue growth is already at 9% year over year, and the AI orders are accelerating, $2.1 billion last quarter versus $1.3 billion the quarter before. PS ratio is 5.34. EPS on a trailing basis is about 282. The dividend yield is 2.13%, which isn't bad for a growth tech name.
How does the revenue trend look quarter to quarter?
Steadily accelerating. The most recent quarter, Q2 FY2026, was $15.3 billion, up from $14.9 the prior quarter. A year ago, it was $14 billion. So you're seeing real momentum here, driven primarily by product revenue growth of 14%. Services were roughly flat.
What about margins?
Gross margin is 65%, which is outstanding. Operating margin is 22% on a GAAP basis or 34.6% non-GAAP. Those are very strong numbers, but there's a near-term headwind. Management flagged that Q3 gross margins could compress about 150 basis points due to AI revenue mix and memory costs. So margins are great today, but the direction matters.
Cash flow?
Cisco generates $13.3 billion in operating cash flow and $12.2 billion in free cash flow. They're sitting on $15.8 billion in cash against $31.7 billion in total debt, so a debt to equity of 0.67. The balance sheet is solid, not fortress level like some consumer staples names, but more than adequate for a company generating this much cash. Overall, Cisco's financial health is solid. 65% gross margins, $12 billion in free cash flow, and 77% market share. The AI pivot is working, but the valuation at 28 times trailing earnings leaves limited room for disappointment.
Where do analysts come down on this one?
26 analysts cover Cisco, and the consensus is a buy. 17 buys, 8 holds, 1 sell. The average price target is $88, implying about 10% upside from current levels. The range runs from 67 on the low end, that's Morgan Stanley worried about valuation and margin pressure, to $100 from Evercore, who thinks the AI infrastructure thesis is underappreciated.
10% upside is more modest than what we saw with some of the other names.
Right, because the stock has already had a big run. It's up from $52 at its 52-week low to $80 today. A lot of the AI narrative is priced in. The question is whether the AI revenue ramp exceeds expectations enough to push through 90.
Last earnings?
Q2 fiscal 2026 reported in February. Revenue of $15.3 billion beat consensus by about 1.5%. Non-GAAP EPS of $1.04 beat by roughly 2%. Revenue growth was 10% year over year, with product revenue up 14%. The big headline was AI orders hitting $2.1 billion. That's a 62% sequential increase. Guidance calls for full-year revenue of $60 to $61 billion and EPS of $4.08 to $4.14.
All right, bull case. The biggest catalyst is the hyperscaler AI build-out. 5 of the 6 largest hyperscalers are now designing Cisco gear into their AI clusters. The Silicon One G300 chip is purpose-built for AI networking, and orders are accelerating. $2.1 billion last quarter, with $3 billion expected for the full year. If the AI infrastructure cycle plays out as expected, Cisco could be generating $5 to $8 billion annually in AI revenue by 2028. Second, the campus refresh cycle. Billions of dollars in installed switches are approaching end of life, and that creates a multi-year runway of high-margin replacement revenue. And third, the NVIDIA partnership and ecosystem wins are creating platform lock-in that should generate follow-on software and services revenue for years.
The bear case starts with valuation. At 28 times trailing earnings, Cisco is priced near multi-year highs. If AI CapEx spending slows or hyperscalers pull back, the stock is vulnerable to a sharp correction. Second, competition. Arista Networks is growing at 27% and capturing cloud-native workloads. Juniper is making inroads in AI data center switching. Cisco's dominance is real, but the premium segments are contested. Third, margin pressure. Management already flagged 150 basis points of gross margin compression in Q3 from AI mix and memory costs. Lower margin hardware isn't the same economics as recurring software revenue. And fourth, macro risk. If enterprise IT spending contracts in a recession, both the campus refresh and AI build-out timelines could stretch, leaving Cisco exposed to a growth deceleration at premium valuations.
Let's compare Cisco to the peers.
The most instructive comparison is Arista Networks. Arista trades at 55 times earnings, almost double Cisco's multiple, but is growing at 27% versus Cisco's 9%. So you're paying up for faster growth, but Cisco's AI-specific growth rate is probably closer to 20 to 25%, which narrows that gap considerably. Juniper sits in the middle at 38 times with 12% growth, and Palo Alto Networks is the outlier at 92 times. But that's a different business. Pure cybersecurity, not networking.
So Cisco is the value play in the group.
Exactly. Lowest PE, lowest PS, strong growth, 77% market share. The risk-reward arguably favors Cisco over Arista at these valuations, assuming the AI infrastructure thesis holds. If it doesn't, Cisco has the recurring campus networking business as a floor.
What's the options market telling us?
The put-call ratio is 0.45, which is notably bullish, more than 2 calls for every put. Open interest clusters at the $85 and $90 call strikes, signaling the market expects near-term upside. Implied volatility is in the 55th percentile, moderate, not extreme. Minimal defensive put positioning below 75. Overall, options traders are positioned for continued upside momentum.
Any insider signals?
CEO Chuck Robbins sold about 19,500 shares at $76 in February, roughly $1.5 million. Total insider selling over the past 90 days was about 81 million. But that represents just 0.01% of the float. The selling is overwhelmingly RSU vesting and tax-driven, not conviction-based, no insider buying, which is a slightly negative signal, but typical for a mega-cap where insiders own very little relative to the total float.
What should investors be tracking?
The number one metric is AI orders. If Q3 AI bookings accelerate above 2.5 billion, it confirms the thesis and likely pushes the stock through 90. If orders flatten or decline, the premium valuation unwinds quickly. Second, watch gross margins in Q3. Management flagged 150 basis points of compression. If actual compression is worse, it signals that AI revenue is dilutive to profitability. And third, track the competitive dynamic with Arista. Market share shifts in cloud networking will determine whether Cisco's premium is sustainable.
When's the next catalyst?
Q3 fiscal 2026 earnings expected in May. That'll be the most important data point for the AI infrastructure thesis.
Here's the summary on Cisco. $319 billion company, 77% of the networking market, $12 billion in free cash flow, 9% revenue growth accelerating on the back of a massive AI infrastructure cycle. The stock has rallied 50% from its lows, and at 28 times trailing earnings, the market is pricing in a lot of good news.
The opportunity depends entirely on whether you believe the AI infrastructure build-out sustains. If Cisco delivers on the $3 billion AI revenue target and AI orders keep accelerating, the forward PE of 17 times looks very attractive. If AI CapEx slows, the stock is expensive. For income investors, the 2% dividend yield and fortress cash flow provide a floor. For growth investors, this is a show-me the AI revenue story.
I want to close with something the CEO himself said. Chuck Robbins put it this way: the network is no longer a utility, it's the engine of your AI strategy. And that's really the thesis in one sentence. If that's true, Cisco is sitting at the center of the most important technology shift of the decade.
And if it's not true, they still have 77% of the networking market and $12 billion in free cash flow. There are worse fallback positions.
That's going to do it for episode 81 of Charged Alpha, our deep dive into Cisco Systems, ticker CSCO. If this breakdown was useful, hit subscribe so you catch every episode. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.